Now, back by popular demand, it's the Lance Roberts Show.
And welcome back. It is, of course, Tuesday morning here on your drive into work, 6:06 as we get the day underway. Talking about the world at large. A lot of things going on today. But most importantly, it is Hump Day Eve. So I ran into a lady in an elevator yesterday, and I said, "Hey, how are you doing today?" And I always ask people in the elevator how they're doing. And she says, "Well, it's Monday." I go, "Well, just, look on the bright side. Tuesday will be here before you know it." So this is, everybody's like this. We're always looking for the next day. So Hump Day Eve, got to keep the positive spin on things here.
I got too much to do today to worry about tomorrow.
I have too much to do every day. Yeah. Anyway, a lot of stuff to get into today, and a few stories. Let's do kind of check in on the markets here real quick. Markets are pointing up nicely this morning as kind of the, and this is something we're going to talk about more in depth tomorrow, as well. Of course, is the Federal Reserve is on deck. Big meeting tomorrow from the Federal Reserve. And, of course, the big question is, whether or not they are going to lift interest rates. And, of course, the expectation is they will not hike interest rates at tomorrow's meeting. But it was interesting because as we've now paused on interest rate hikes, and, of course, the Fed has become much more dovish, which has helped lift the markets from the December 24th lows where we had this very large correction last year. It was we've had several discussions here on the show about how quickly both the Trump administration as well as the Federal Reserve reversed course on policy strategy when the markets cracked. And remember, we talked about back in October, the Federal Reserve was saying, hey, we're nowhere close to neutral. We've got to keep raising rates. The economy is growing strongly, so we've got to raise rates to offset the strongly growing economy to keep inflation under control. And, of course, the Trump administration at the time was very much pressing on trade tariffs and this trade war. And, of course, after the market tanks by 20% between October and December, all of a sudden a big reversal, right? Fed's now, we're done hiking rates. And, in fact, we're done reducing our balance sheet. We're about where we need to be now. And, of course, there's been a very rapid reversion, of course, on the stance on trade. Now we're in a rush to get the trade deal done. And so, of course, that's lifted asset prices. And today, markets are looking positive. The Dow is looking to open up about 125 points. The S&P is looking to open up near 11. So, again, we continue this push. Now, we've got an article out on our website this morning. It's our Technically Speaking post that we do every Tuesday, talking about a look at full market cycles and, where we are in this current one. And as we talk about the economy, the markets, political policy, et cetera. There's a lot of things that drive into the long-term health and growth of an economy and, of course, subsequently markets. And I thought it was interesting. Bloomberg had an interesting article out this morning talking about the fact that a recession is coming. This is the title. I'm not making this up. A recession is coming and maybe a bear market as well. First of all, whenever you have a recession in the economy, you always have a bear market in stocks because of the relationship between corporate profitability and asset prices. That's just, people invest in stocks because they're buying an expectation on future growth of the company. And of course, when there's a recession in the economy, you subsequently also have a bear market in stocks because of the revision of the belief in what you were paying for profits for that company. In other words, it's fantasy becomes reality again, right? We always tend to get a little bit exuberant during market peaks and late stage market cycles about, the market's just going to continue to do, this forever into the future. And then when it doesn't turn out to be the case, we have this revision in expectations. So the reality is that during bear markets, during recessions, stocks fall on average about 33%, on average, going back to 1871. So if we look at all the bear markets throughout history. If we look at just post-World War II, it's still well over 20%. So, the issue is that we are in a very late-stage economy. Things are happening on a global basis. We're seeing global economic slowdowns. We're seeing weakness in yields And what's important about yields is that the bond market is a very good indicator and a very good way to look at whether or not the economy is growing strongly or not. There is a very close relationship between the direction and trend of interest rates and the level relative to economic growth. So, for instance, we go back in history and let's go back to 1980 when Reagan was in office. Reagan enters office, and of course, inflation and interest rates are running 12, 13, 14%, but economic growth was running between 8 and 9% at the time. So interest rates and inflation had gotten ahead of the rate of economic growth, and that was the concern. We were having kind of an expectation of interest rates and inflation well above the level of economic growth. So, of course, this is where Paul Volcker and Ronald Reagan got to work trying to lower interest rates and lower the rate of inflation. And ever since then, we've been increasing the rate of debt and deficit spending that we're doing. That's another issue relating to long-term economic growth. But economic growth since then has declined from about 8 to 9% down to roughly 2% today. If we take a look at nominal GDP growth, and of course what we're looking at this year in the economy, is we're looking for nominal GDP growth to be around 3%, whereas interest rates around 3%. And that's about where it should be. So when you look on a global basis, you're looking at a lot of yields on government debt around the world close to zero. And that's not surprising given the fact that global economic growth is very weak. But here's the problem. Countries haven't figured out a way to stimulate economic growth. We've tried all types of monetary interventions. We've tried all types of other tricks, and parlor tricks and et cetera, to try to stimulate economic growth, but none of it's worked. And we continue to have this division between economic growth and jobs and job creation and the division of wealth. And this has become the rallying call for people like Ocasio-Cortez talking about we need to tax the wealthy more. We need to solve this inequality gap. We need to create we need to change the world dynamic because, well, the one we've got isn't working anymore. And it's not working because of the debt. But we'll come back. We'll talk some more about this. I've got a few pieces that go along. It's kind of an integrated story this morning that we'll get to, but I've got a few pieces about how this all ties together from Illinois to millennials and, of course, even to the world at large. So don't go away. More of the Lance Roberts Show coming up right after the break.
Let's go down and check out the show. Yeah, they were dancing and singing and moving to the grooving. And just when it hit me, somebody turned around and shouted, "Play that funky music, white boy. Play that funky music, right."
Catch Lance Roberts' podcast later at lancerobertsshow.com.